Good evening, students. I hope you had a very good day today. This is a very short lecture on cost accounting ledger, which is chapter 7 in your study material. Now let's see in detail. Now, ledger accounting is something which dealing with the maintenance of system. Suppose in case if there is going to be a non-integral system. What do you mean by non-integral system? Means keeping the financial books separate, keeping the costing books separate. So there will be two sets of books. So non-integral accounts. And what does it? So financial books, you know that the normal entries, general entries, and everything you know. So financial books, what types of entries it comes, you are familiar with. What this costing books will contain? It will simply contain cost incurred and the revenue generated for that cost and profit or loss. Costing books is more of an information setup. You want to know how much amount of cost is incurred at each stage of production, etc. And when it matched with the revenue, what is going to be the profit and loss? It is only an informative set of books, because you are not going to create a balance sheet from costing books. So at most, it gives the information of cost incurred and the matched revenue and gives you the profit and loss. The financial books is the one which have everything there. For example, costing book does not deal with dividends, income tax, and all those things. But whereas the financial book deals with everything. So the scope of financial book is very wide. Whereas the scope of costing book is a bit limited only for costs incurred and for comparing with the revenue generated. So there is a line of difference between this objective of maintaining these books. And in costing, only the nominal accounts are considered. The real accounts and personal accounts are not considered. I hope you are very well aware with the 3 golden rules. Right from the 11th standard, you would be hearing this: real account, personal account, and nominal account. The costing deals only with the nominal books, nominal accounts. But have it in mind, this costing book is also based on double entry. The financial book is also based on double entry. Books is also based on double entry. Now, when I say only the nominal accounts will come in the costing books, and you would definitely have a kind of doubt how the double entry are going to get complete. So there's a way we complete the double entry, because remember, costing book is also double entry and financial book is also double entry. So nothing is a kind of single entry. So if I say nominal accounts, it's not a single entry, it's a double entry. Now, how this double entry is being populated in costing books when compared to financial books, let's see in the next slide. And then logically think, if you maintain two sets of accounts, then, and there is a difference in scope, because this contains certain items which may not be reflected here, like income tax, dividends, etc. So there bound to be a difference in profit generated by financial records and profit generated by the costing records. Obviously, for example, the stock valuation, you might have used FIFO for financial books, whereas in costing books, you would have used weighted average. So definitely there will be a difference in valuation, and that might give rise to a certain amount of difference. So when you have two sets of books, that is the non-integral, when it is each are separate parallel lines, not related to at all. When you have a non-integral accounts, then there is going to raise a difference in profit or loss shown by these both books. That is where you have this part coming into play, reconciliation between financial books and costing books. It's relevant only when the set of books are non-integral. It's non-integrated. Costing is separate, financial books are separate. Now somebody thought, okay, why you have two sets of books? So let's merge it together to have a comprehensive view and eliminate this particular thing. So there arise the integral accounts where the costing books and the financial books are merged together. There will be only one set of books and there will be only one set of profit. So here, the real, nominal, and personal accounts are considered. Let's see how it behaves. Let's take a journal entry and see how it behaves in non-integral accounts. First, we will see 2 or 3 entries, and then we will see how it behaves in an integral account. Just a bird's eye view. The concept, so once you understand the concept, then obviously it's only the matter of transaction you have to translate into double entry. Now, you have 2 ledgers here. One is costing ledger and one is financial ledger. Goods purchased from ABC Limited for credit 1,000 rupees. So what entry you will be writing in financial books? Purchases account debtor to ABC Limited, 1,000 rupees. This is the one which you will be writing in your financial books. How this is replicated or how this is dealt in cost accounting ledger is, here under purchases, you are bringing together all the goods under purchases category. Here what you will be doing is, you will be doing stores ledger control account debtor 1,000. Then you may ask how to complete the double entry, because personal account is not considered in costing. So here you will complete the entry by putting general ledger adjustment account. This can also be costing ledger control account. Both are same. The trick is your real account and your personal account are translated as general ledger adjustment account. And your purchases, since you group the goods under purchases in financial books, you are grouping it under stores ledger control account. So I think you are pretty getting familiarized with how you populate the entry in financial books and costing books, right? Now next is take the next one, goods issued to production worth 20,000 rupees. So the production, you call it as work in progress control account data 20,000 to stores ledger control account. Because here you will find that double entry components both are available. Because you are debiting the work in progress and you are crediting your stores ledger control account for issue of materials. So since you have both the accounts available, so there is no necessary for your general ledger adjustment account here. So both the components are available in costing, cost ledger control account. Both the entries, so you can pass a double entry without the general ledger adjustment account in the costing book, because you debit work in progress control account 20,000 and to stores ledger control account where the goods are being issued. So credit stores ledger control account. So debit the work in progress, credit the stores ledger control account. In financial books, you won't be passing any entry because you are keeping it separate. So you are not passing any entry here. Now next is see how the materials returned to vendor, 10,000 rupees. Now this again the journal entry which you can put in financial ledger is assuming that you are returning to ABC Limited. ABC Limited data 10,000 to purchases or purchase returns. So whatever you may, I am just taking as purchases. To purchases. So you are reversing the entry. So you are debiting the personal account and creating the purchases. Now how this comes here? Now the purchases is, as I told you, is represented by stores ledger control account. $10,000. Now how to complete the double entry? Personal account is translated as general ledger adjustment account data 10,000. So double entry completed in both sections. This purchases becomes stores ledger control account because the grouping is different. Because in cost ledger you are grouping the goods under stores ledger. So you use that terminology in costing ledger. Whereas in financial books you group all your goods under purchases. So you use purchases account. Now indirect materials issued to production. Indirect material, remember cost sheet. So indirect material issued to production, what it will be coming in cost sheet? Production overhead, control account, data to stores ledger control account 5,000. Both the components are available in your costing ledger. So there is no necessity for going for general ledger adjustment account. You should be very careful on that. So only when you encounter a personal account or a real account, then that is gets substituted by general ledger adjustment account for completing the double entry in your costing ledger. It's very simple as it is. So immediately when you see a entry, then obviously your subconscious mind will put a financial entry, financial books as per the financial books. Obviously your subconscious mind will put only the entry as per the financial books. So no problem. You recollect what is being done in the financial books and just replace the real account and a nominal, real account and personal account with general ledger adjustment account. Simple. And you just know the terminologies that are being used in the two different ledgers. Here purchases, there stores ledger control account. So this you tend to know it, the more when you start practicing and the more problem we both together will work out a lot of problems. So then you will be in a position to understand much more, because now we are in the journal entry stage. So once the next step we will be directly doing the ledger accounts. So we'll be directly passing the double entry with ledgers straight away, instead of passing a journal entry and then coming to ledger. So since I want you to understand the concept behind passing the entries in both the ledgers, I'm just giving you some of the examples. So here, there will be no entry, because this is purely concerned with costing ledger. Now, materials returned from production to stores. What entry will be used? Stores ledger control account. Data, say assuming that it should be 5,000 rupees. 5,000 to production overhead control account 5,000. The two elements are available here, so we need not go for general ledger adjustment account. There will be no entry here. Why there should be entry? Because this is purely related to costing process flow. For each process flow, you are passing a journal entry there. Here you are not passing as per each process flow. Wages paid to workers. Remember your cost sheet. It's more or less borrowed from the cost sheet. See, the cost sheet is in a statement form. So this comes in a T format. When you go for ledger in the coming classes, when you go for directly the ledger, it will be in T format. Mostly, the terminologies will be mostly be used what you use for cost sheet. So wages paid to workers. So assuming that this is the direct wages. So wages paid to workers is, assuming that's the direct wages, wages control account, data to, what will be the entry here? Wages account, data to bank. So can we put bank account here? No. So you have to put general ledger adjustment account, 1,000 rupees. So this is the basic way of creating the entries, in populating the entries, and you have very well know that certain entries comes only in the costing ledger and not in the finance ledger because it is non-integrated. Then let us see how the situation changes when you merge these two. Let's do that piece by piece. Let's not jump into the ocean immediately. So we are just in the waves. We are just getting into the waves, and let's get the feel of what the entries are being put. The overhead incurs. Production overhead, administrating overhead, selling and distribution overhead, expenses and distribution expenses. So what entry you will be putting here? Production expenses that are 1,000. Admin expenses that are 5,000. Selling expenses that are 6,000. Distribution expenses account that are 7,000. You may put either as a bank or outstanding expenses. So it's just creating an outstanding expenses account. Or let's take so let's not get confused. Let's be the same way. Let's use bank account. So was that 6,000, 12,000, 19,000? I think I'm correct. So what entry you will be putting it in costing ledger? Costing ledger you will be repeating the same. Production expense Production overhead control account 1000. Admin overhead control account 5000. Selling overhead control account 6000. Distribution overhead control account 7000. You can't use a personal account, or you cannot use outstanding expenses account, because outstanding expenses, when you are going to reverse, it will be again reversed with a bank account. So you can't use that. I just used it to have a difference, but let's have a pack for uniform understanding. So you have a real account or a personal account here. So it is general ledger control account 19,000. We're able to get it. So far so good. Now simple trick, before winding up, a simple trick I say, when you get integrated, what will happen? When you get integrated, this will remain from costing books, and this will remain in financial books. So it will be production expenses control account 1000, admin overheads control account 5000, selling overheads control account 6000, distribution overhead account 6000. Here you will be putting as bank account 19,000. This is for my God, something wrong with that. This is for integrated account. Don't get confused. When you merge these two, from the costing records, this remains, and from financial records, this remains. So automatically, this general ledger control account goes up. In integral accounts, I'm just giving you a glimpse. Don't get confused. Let's first practice non-integral account first. So let's get into that. So the next lecture, we will be working on straightly the ledger accounts. We won't be putting the journal entries. And I hope that you got a fair understanding of how we pass the entry in financial ledger and costing ledger. So the next step, we would be using the institute material, and we would be putting the illustrations with I think there are problems with where you put journal entries and also ledger. So we will do that. So whatever the institute material has done it, we will work out the board, and we will see how it gets reflected directly in the lecture. So I hope in this video you have some basic familiarity with how the journal entries are being passed in this both set of accounts. So thank you very much. We will soon meet in the next lecture. It's because it's continuing part. So good luck.